Good morning. Welcome to the investment meeting of the Teachers Retirement Board for February 4th, 2021. I'm going to start by taking the roll. John Adler.
I'm here.
Thomas Brown.
I'm here, Patricia. Good morning.
Good morning. Natalie Green Giles.
I am here.
David Gazansky.
Present.
Russell Buckley.
Here.
Deborah Penny.
Good morning, here.
And Susanna Vickers.
Good morning, I'm here.
We have a quorum, so I'll turn it over to the chair.
Okay, good morning, everyone. We're going to start with a review of the Passport Funds December 2020. And Robin or John, would you, Michael, I'm sorry, will you take it away? Mike?
Sure, will do. And I would be happy to share the report on screen if that's helpful. Liz, are you able to enable that capability?
Well, I think we all have, I think we agreed that we all have copies of it, so we'll just,
Okay.
No need to share.
Absolutely. That certainly will make speaking to it a little easier as well. So I think, we already did spend some time talking about what happened in the markets during December. So I won't dive too much into December, given that came up in January at that meeting, but I will spend a couple extra seconds just wrapping up 2020, if you will, and the fourth quarter as well. And if you're following along on the report, you'll note that last year, again, as we discussed, very strong year for absolute returns across the board with respect to the plan. Quite striking when you think about the volatility we saw early on in 2020, and the diversified equity fund, absolute returns certainly helped by market activity. But what we did see also in the fourth quarter was a pretty strong environment for the active managers in the program as well. So I'll speak to that a little bit and what was working behind the scenes. But if you're looking at the very top line with performance, for the month of December, the diversified equity fund with about 17.9 billion in assets, up about 5%. That put the fund ahead of both its hybrid and market benchmark. And when I say market benchmark, I'm referring here again to the Russell 3000 index, which was up about 4.5% during December. That brought the calendar year return for the fund to about positive 18.2%. So the fund did lag by about 1% from the hybrid benchmark, or versus the hybrid benchmark for the year calendar year 2020. And the Russell 3 during that time period was up about 2.9%. So what drove the absolute and relative returns for 2020? And in particular, the fourth quarter, which you see in the 3-month column, pretty strong numbers as well in both absolute and relative terms. So for the year, active management for U.S. equity strategies was something that was a drag on the fund. We talked about the dynamic with growth and value earlier in the year quite a bit. In the fourth quarter, we did see that reverse, and many have referred to the fourth quarter, perhaps rightfully so, as a value rally. Value indices for the quarter outperformed by about 500 basis points. And actually, what was really interesting, if you look at the time period of November 6th to November 24th, so really a short part of the fourth quarter, value outperformed growth by about 950 basis points in those couple of weeks alone. So it was really interesting. If you peel it back a little bit further, was it just value? But what we also saw was more of a rally in the highest beta stocks relative to lower beta stocks in the US, and higher beta outperformed by about 28% during the fourth quarter. Small caps also outperformed large caps by about 11% for the quarter. So those are all things that did work well for active management during the fourth quarter. You can see here, again, a pretty strong relative result of 22.7 versus 14.7 for the active composite in the US. And all told, last year was also a pretty strong environment for the international equity composite that you can see with a return of about 15% versus its composite benchmark at 10.6. It's worth noting the defensive composite did lag its composite benchmark for the year, but it did contribute to the overall absolute returns in perhaps a meaningful way, up about 19%, versus the fund return, which I noted earlier at about 18.2. So, all told, pretty strong absolute returns there. And again, we're going to spend a little bit more time looking at the active manager performance for defensive when we review the composite in a little bit more detail during the second quarter of 2021.
Particularly, just to jump in, particularly notable, and we'll talk more about this as Mike mentioned when we focus on the defensive composite in coming meetings, but the performance of the two convertible strategies in the defensive composite are particularly notable for the calendar year, up between 42 and 43%.
Thanks, Robin. And so beyond the diversified equity fund, you can see the returns for the rest of passport funds. The balanced fund with just over 500 million in assets, that was up about 8.7% for 2020. The international equity fund up about 14.5% ahead of its benchmark. The sustainable equity fund, again, if you think about the types of companies that are being populated or purchased in that strategy, they tend to be larger cap US growth strategies that have obviously met the sustainable criteria of the fund manager. Given that large growth part of the market did really well last year as well, this fund up about 38.7%. The US equity index fund, I noted index returns last year. The underlying strategy for this fund was up about 20.8% in line with the US market. What jumps off the page here is the fund's specific return, the return that participants got who were invested in this fund for the whole year. They were actually up about 40%. And again, what's driving that is the timing of cash flows. So you'll note that notable cash flows came into this fund, after the market sold off last year. And so there was more money invested in this fund to catch the rebound, given that this fund was really only launched on 1/1/2020. The same dynamic is true for the International Equity Index Fund. Again, this fund, the underlying strategy, if you will, the mutual fund that is underlying the passport fund option was up about 11.1% and roughly in line with its benchmark, but the fund itself was up about 29.9%. So I'll pause there and see if there's any questions. And if there's not, we'll move ahead and speak a little bit about what we've seen so far this year.
I guess you can move ahead.
Great. So everyone should have the attachment that was circulated. We just called it the January preliminary benchmark report. And what you'll note here is returns for January that nearly everywhere across the board are negative, mostly modestly negative. But what we did see in January, you'll recall, was a pretty strong start to the year with respect to markets. The market did shake off some of the political turmoil and what we saw in Washington during the first week of the year. And it wasn't until really the later part of January that we saw equity markets, for example, sell off a little bit. The Russell 3000 ended the month of January down about 40 basis points. International stocks were more mixed. So in developed markets outside the US, the EFI index was down about 1%, but emerging markets were up about 3%. So that definitely served to offset the downside in developed markets. If you're looking at that report, the defensive strategies composite, we're expecting a positive return there to the tune of just shy of 0.5%. And the diversified equity funds hybrid benchmark for the month was down about 27 basis points. And so I kind of covered the underlying asset classes as I was going through the diversified equity fund, but you can see the balanced fund all told probably down about 10 basis points. I noted the international equity underlying indices, but that the international composite benchmark as a whole was roughly flat. And we saw what was a more negative month for the underlying strategy of the sustainable equity fund, down about 2% relative to its benchmark, which was down about 75 basis points. And then you can see, as I noted earlier, the underlying strategies for the US index and the non-US index. The US index was down about 33 basis points, and the non-US index fund positive return of about 15 basis points. Were there any questions about January?
Guess not.
Not hearing anything. So the next item on the agenda, and we had discussed at the last meeting, bringing in some market experts to speak to their views on the marketplace. And so I will turn it over to JP Morgan and their chief economist at JP Morgan Asset Management, chief strategist David Kelly. But before I do, I think what we've done is we've allocated about 30 minutes for this conversation. And we've asked David to save some time at the end for questions. So if you do have any questions, it might be easier just given the Zoom dynamic to hold off, and we'll make sure that he has some time to address that at the end. I think we'll take it from there, and I'll turn it over to John.
Great. And I guess, Liz, I'm sorry, David, we can give David the share screen capability, so we certainly could look at that.
That's already been taken care of.
Great. Okay, so you can put that up.
Thanks.
Thank you.
Thanks, Deborah. So this is John O'Shea. Just real quick, maybe two things for you to know about David. First, I'm a client advisor. I've been working with New York City's retirement systems for 15 of my 25 years here at JP Morgan Asset Management. So we are honored and delighted to be able to speak with you today. So David is a chief global strategist at JP Morgan. So he heads a global team of 27 folks who are located in 12 countries. So we're going to bring you a global perspective as we always do. And just secondly, you might be aware of their most notable publication, Guide to the Markets, which is a reflection on current economic data and changing market conditions across the globe. But interestingly, we publish this in 33 countries and 12 different languages. And we refresh the data every day. So what we'll talk about is real time and relevant with hopefully a little bit longer term perspective. And we also have a sister publication, Guide to Alternatives. And for you, what we pride ourselves on is these two publications and the insights that this team generates being intelligible and digestible by a wide range of expertise. So David's got screen share capabilities like nobody. So let me turn it to you, David, to take it away.
Well, first of all, thank you very much for this opportunity, and let me see if this can work here. So I'm going to try and share the screen.
There you go.
Okay, now you're seeing, hopefully you can see my screen now. I'll just make this presentation bigger here. Okay, can everybody see the presentation? Okay.
Yes.
Okay.
Super. So what I want to do is, I've got 25 pages here. I'm not going to talk to all of them, and I'll try to be succinct. But what I really try to do, and what we try to do in our group, is really focus on seeing the present with clarity, much more than forecasting. And so I really want to talk about where we are right now on the pandemic. I think also in terms of the economic outlook and how fiscal and monetary policy are going to play into that. And then I want to talk about some issues on valuations, which I think are somewhat concerning, but then also some opportunities. And I'm going to try and do this all in the course of 20 minutes, so we have time for some questions here. The first thing, though, let me talk about where we are in the pandemic. Now, I don't claim to be an epidemiologist, but I think we've all learned a lot about this over the course of the last year. So I think there is some hope here on the vaccine and the pandemic that we shouldn't miss. Obviously, the toll is dreadful, with 450,000 people having died from COVID-19 in the United States. That is a horrific death toll, and we're still seeing about 20,000 people die every week from it. However, there are some positive signs. You can see in this chart here, the blue line is a 7-day moving average of confirmed cases. The gray line is a 7-day moving average of fatalities. And you can see that the confirmed cases have turned down, and as we all know, that is a precursor to declines in the number of fatalities. With regard to and so I think that we're right now probably at the peak of fatalities, and probably past the peak in terms of the number of people who are going to catch this per week. In terms of vaccines, we've got two that are actually approved at this stage and are being used in the United States, the Moderna and the Pfizer one. I think it's important to recognize that these two companies have promised that they will deliver 200 million doses each by the end of June. And I don't see any reason why they won't be able to do that. And also, even though there's a somewhat chaotic rollout in some states and every state is different and it's really not, it's not looking great from that perspective, I do think that everybody's got a huge interest in getting this job done, and they will get it done. And so by the end of July, I expect that those 400 million doses, so that's enough for 200 million individuals, will have been essentially deployed to the extent that Americans are willing to take the vaccine. Now, we know that right now these two vaccines are only approved for adults. There are 260 million Americans over the age of 18, but we know that less than 70% have expressed a willingness to actually take the vaccines. That gets you to about 182 million. So right now we've got 182 million willing adults. We should have 200 million vaccine or the capability to vaccinate 200 million people, even without the approval of any other vaccine. And I think others will be approved between now and the end of June. By the end of July, then allowing for the delays in, when you get the vaccine in a local area and when it's actually deployed, maybe by the end of July, we will have hit that target of 70% of the adult population being vaccinated. However, in addition to that, sadly, we've got this enormous number of fatalities, but what that also means is that actually an awful lot of Americans have already had this. So we've got 450,000 people who've died from this right now. Epidemiologists say that as a rough number, about 0.5% of people who catch COVID-19 die from it. So if that's true, then 450,000 people having died from it right now ought to represent about 90 million people who've had the disease. But that's actually 90 million people as of 3 weeks ago. Since then, if over the next 3 weeks, sadly, another 50 or 60,000 people die from this, then that gets you up to a total number of people who've had the disease at this stage, at this point, of about 100 million people. So that's roughly 30% of the population. If you look at the vaccinations, we're running at about 3 or 4% of the population right now. So already a third of the population has some immunity to COVID-19. As we run the numbers, by the end of March, 50% of the population will have some immunity to COVID-19. And by the end of July, 80% of the population will have some immunity to COVID-19, most of whom will have got that immunity through vaccination, but a very sizable minority of those people will have got it because they simply caught the disease. And at that level, at 80%, having some immunity, I do think that the virus will die down. Now, there are mutations. We're worried about those. Everybody is. I think the medical community is working on tweaking the vaccines to be able to deal with these mutations. But I think it is reasonable that if we've got this, to believe that if we've got this level of herd immunity as we go into the fall, and if we have better contact tracing and testing, then I think that as you go into that fourth quarter, we are going to be able to more or less get back to normal, certainly from a macroeconomic perspective. So what does this mean in terms of the economy? Well, the people asked me at the start of this, are we looking at a V-shaped recession, W-shaped recession? It was always going to be a weird shape, and that weird shape is now emerging. So it was always going to be a plunge, a surge, a crawl, another surge, and then a normalization. And we've seen the plunge, and you see that in that chart, and we've seen the surge in the third quarter of last year, and then another 4% added to GDP growth in the fourth quarter. But of course, even though the numbers look similar on the way down and the way up, they're not, of course, because 30% from the top is far more important than 30% from the bottom. So we're still very far short, about 2.5% below where we were a year ago in terms of overall output, and even further, relative to where we should be. Going forward, we think the first quarter is going to be very slow economic growth. It would have been anyway, but I think that the passage of some coronavirus relief at the end of December will help. I think we will avoid an overall negative quarter, but I'm looking for economic growth of about 1 to 2% for the first quarter. But then it should begin to accelerate. Just getting past the pandemic will cause it to accelerate mightily. Because as you go into the fourth quarter of this year, there is going to be a pent-up demand and a pent-up supply of consumer services, hotels, restaurants, travel, leisure, entertainment, personal services. All these things that have been basically shut down because of the pandemic are going to reopen. And there are many businesses like restaurants which can't, unfortunately are going to open up under new management, but it doesn't change the fact that there's going to be a ferocious demand for these things. I mean, after all this period of time, people are going to want to get out and party. I think the real challenge in the fourth quarter of 2021 is going to be trying to find a table at a restaurant or a seat in an airline or a bed in a hotel. And I think you get that surge of economic activity. And that was going to happen anyway. And then you're going to have, after we've sort of satiated our need to see the relatives and travel all over the country, I think things die down again and you have more normal growth as you go through the second half of 2022. But superimposed upon this is the new coronavirus relief bill. Now, where we stand right now is, as you know, President Biden has met with 10 Republican senators in a hope to reach some bipartisan compromise on this bill. I think that I take the president absolutely at his word that he would like to be bipartisan about this. But the reality is he probably cannot cut his bill enough to satisfy those 10 senators and achieve what he wants to achieve. And if he falls short of those 10 senators, then he's going to have to go to reconciliation, and that's what's going to happen. When he's using the reconciliation process, he only needs to keep all the Democratic senators in line, and that may mean some compromises, which I think will reduce the overall size of the package, but we're still talking about a massive package. I mean, he proposed $1.9 trillion. I wouldn't be surprised if we end up with something like $1.5 trillion getting past Congress, signed into law by the middle of March using the reconciliation process. And if that happens, if you look at the details, it's so front-loaded. I mean, about, over $1 trillion of this will probably be spent between now and the end of September. And that will supercharge an already improving economy. I think it will shorten the pandemic somewhat by helping with vaccine distribution and testing and tracing. I think it will help support households through the end of the pandemic by enhanced unemployment benefits and expanded unemployment benefits. I think it will help state and local governments. I think it'll do a lot of good things, but it will also leave the economy with tremendous momentum going into the end of the year. And so I think you'll see this sort of supercharged economic growth as you go through the end of the year. And the result of that, if you look at the next page, is I think unemployment's going to come down at a record pace. Now, I mean, this is already a really unusual recession. We got to the highest unemployment rate since the Great Depression early on. We're now down at 6.7%. That 6.7% understates the level of economic weakness right now, because we know that 4 million people have left the labor force in the last year. And they left the labor force because their industries are shut down. And they're not looking for a job, and so they're not counted as unemployed. If you add those people back, you're about 9.3% on the unemployment rate. But even with that, given this pace of economic growth, I expect those people, most of them will come back into the labor force, and the unemployment rate itself will fall to below 5% by the end of this year, and then fall in the course of 2022 down to close to 4%. So I think you'll see a fast recovery in employment. On inflation, I think you'll see a little bit more inflation. Now, right now, the number we look at on inflation is down here. Let me draw a picture here. See this area here? It's the PCE deflator. That PCE deflator that's what the Fed is targeting, and they want that number to be at 2%, and we're not there. But by April, I think we will be there, because the year-over-year comparison is very easy. If you look at April of last year, you can see how much prices fell. So that comp is very easy. I think you hit 2% inflation then. And then as you wind through this year, if you've got all that extra stimulus pouring into the economy, I think the inflation rate stays a little bit above 2% as measured by the consumption deflator in the fourth quarter of this year and throughout 2022. If you look at profits, have done remarkably well in 2020, given all that was going on. I think you'll see some further gains in 2021 to a new all-time high. In 2022, we could see some further gains, but you're going to see higher interest rates. You're going to see higher wage costs. You're going to see a slowdown in the economy. So there won't be much of a natural increase in 2022, even though we'll be at a record high. And I think a key question, which I don't have an answer to, is are there 50 votes in the Senate to increase the corporate income tax? We know that there are votes in the Senate to pass spending increases and to pass tax cuts, but I'm not sure whether the Democrats will want to pass, or all of them will want to pass, a corporate tax hike before the 2022 elections. If we do see that corporate tax hike up to 28%, then I think profit growth will turn negative in 2022. If not, I think you'll have still a small positive. But either way, profits will grow more slowly from here. A turn to the global picture. This is our global PMI heat map. Green is good, red is bad. You've got the developed countries up top, you've got the emerging markets down below. This is a composite index, by the way. This is looking at the purchasing manager indices for services and for manufacturing. And you can see the big, great financial crisis recession over here. And then you can see the pandemic recession here. What we're seeing right now is China down here. China came out of this thing early because they went into the pandemic first, came out first also. But China has got what I would regard as not terribly effective vaccines, and they've got to vaccinate 1.4 billion people. So I think the West is going to catch up with them. And by the end of this year, the point is the right-hand column of this chart is going to be basically Kelly green. It's going to be green all over the place. The entire global economy is going to be booming in sync because of a wind down of the pandemic. And then last basic point that I think is important is that we do think that over time, the dollar will probably come down. Now it's strengthening a little bit today, but in the long run, you can see in the chart on the left, the dollar is actually very affected by how fast US economic growth is relative to the rest of the world. And in the late 2010s, because first of all of the Trump tax cuts, which gave us a boost in economic growth even late in the cycle, and then because of the trade war, which definitely hurt it hurt all of us, but it hurt the rest of the world more than us, the US actually caught up with the world on growth. But going forward, particularly when you get past 2022, the world is going to reaccelerate relative to the United States. The US does not have enough population growth. Immigration is stalled to basically zero or close to zero. Our natural economic growth is simply slower than places like India and China, and that is going to allow the global economy to grow faster than us, and that should push the dollar down. And that tends to enhance the return on international investments. So on fiscal policy and monetary policy, I won't spend much time. I'd rather leave this for your questions. I do think that we get further deficits this year. These numbers show what the Congressional Budget Office thinks the deficits would be without further policy changes. But I think you will have significant deficits. Does it cause a blow up? Not until interest rates go up. The real problem here would be if the government had to try and finance this debt at interest rates of 4% or 5% or 6%. But right now, financing costs are below 2%. That's not causing a crisis. And then turn to the Federal Reserve. So what the Federal Reserve is uber dovish. It was dovish under Ben Bernanke. It was even more dovish under Janet Yellen. It's certainly dovish right now. And what the Federal Reserve has said is that they are not going to raise the federal funds rate until they have achieved their two objectives of maximum employment and inflation at 2% and on target to exceed 2% for some time. Now, on maximum employment, what's interesting is if you look at the forecast that the Fed officials make on the unemployment rate, they think that the unemployment rate will be down to 3.7% by 2023. And I think that's reasonable. But they also think that even at that point, they will keep the federal funds rate at its current range of 0 to 25 basis points. So what that tells you is their vision of maximum employment is a low unemployment rate. And that says to me that it's going to be a long time, probably late 2023 at the earliest, before the Federal Reserve actually raises short-term interest rates. So what could they do? Well, the thing they could do is cut back on bond purchases. Now, Jay Powell was asked about this at his press conference. And he said, first of all, he needs to see substantial further progress towards these goals in order to back off on asset purchases. Now, if you look at where do we think we're going to be at the end of 2021? Let me just get this here. So the end of 2021, the Federal Reserve believes real GDP growth will be 4.2% year over year, unemployment at 5%, inflation at 1.8%. The thing is, I think growth is going to be stronger than that. I think unemployment is going to be lower than that. I think inflation is going to be higher than that. And if that's the case, the numbers as they are printing at the end of this year would really suggest that the country has made substantial further progress, and the Federal Reserve ought to back off on its asset purchases. But Jay Powell has also said that if we see an increase in inflation as the pandemic ends because everyone wants to go out and party, he will regard that as transitory. And also that the Federal Reserve will announce what it's going to do well in advance of any actual moves. So taking those two things in account, I believe that at the end of December, or perhaps at the January meeting next year, the Federal Reserve will announce that it intends to reduce its bond purchases, but it won't actually reduce its bond purchases until sometime, maybe the meeting in middle of March or the meeting at the end of April. Either way, though, within the next 18 months, I think you'll see a tapering of bond purchases. And remember, this is occurring in an environment where you've got booming global growth, you've got a big US budget deficit, you've got inflation running over 2%. All that suggests to me somewhat higher interest rates. So that's roughly speaking the backdrop. And then just in terms of I know I want to leave time to get to questions here, but where does this leave us? In markets, there are some risks. I think there's some risks because large cap US equities are trading at 161% of their 25-year average compared to, the top 10 stocks are compared to 120% for everything else. So there's a problem in mega cap stocks, we believe. There's a problem in fixed income, which I'm sure you're very aware of. You look at these blue diamonds here are either the spread to worst or the yield to worst on fixed income categories, and there's no income there. And if you do have long-term interest rates rise, there are going to be some capital losses. And I think that is an issue. And then just a broader issue of you don't know when something might go wrong. Nobody really predicted 9/11 or predicted that the subprime bubble would cause the great financial crisis or predicted this pandemic recession. And so, when people ask me, what do I worry about? The truth is the thing that I worry about is the thing that we're not thinking about. And that's the basic reason for diversification. And finally, in terms of messages for investing right now, obviously there are limits. You're very aware as a board of the limitations you have in terms of how you deploy capital. But I think a few things. First of all, we've got to be realistic. We've had some very good returns. If you look at last year, a diversified portfolio gave you 10.6%. Using and this we show the weights here. Everybody's weights are different, and everybody's constraints are different. But overall, that is a good year following a lot of good years, and that suggests to us lower returns going forward. Second, we do think that value stocks look cheap relative to growth. At the end of January, value stocks were 1.23 standard deviations cheap relative to growth. We think that is important. So we think there's some opportunity there. We also think, to the extent that you have the ability to do it, there is some opportunity in international stocks. Emerging market stocks selling well below their long-term average relative to the S&P 500. Developed country international stocks also selling well below their normal discount to the S&P 500. And we also think there's an opportunity in active management. This chart here shows the range between the 20th percentile and the 80th percentile in terms of valuations. And on average, over the last 25 years, that range has been 10.8 PE points. And today, that range is 17.9 PE points. What that says is, in these markets, there are a lot of babies, there's a lot of bathwater. I think particularly, what happened last year is everybody basically doubled down on whatever bets they're making. It was a momentum year. The fog was so thick that people just didn't know what to do. 2021 will be a better year. We will get past this pandemic, but also the fog will clear. And as the fog clears, I think people will pay more attention to valuations. And so I think there's an opportunity for active managers in finding things that are genuinely good value in this environment and underweighting the things that have gotten too frothy in an environment of great uncertainty, but also very easy monetary and fiscal policy. Okay, I know I ran a little long, but those are the main points I want to make, and I'd love to see if I can open up for some questions.
Hey, does anyone have any questions for David or John?
Yeah, I have a question.
Okay.
Thank you for the presentation.
Sure.
Really interesting. I just have a question about your numbers on COVID immunity. Because I think what you're doing is you're saying that, approximately 100 million infections in the US based on fatalities, and that makes sense. And that by March, if you add that 100 million to the number of vaccinations, we're going to approach 50% immunity. But some of the people who were infected are going to get vaccinated.
Yes.
And some of the people that were infected early on are no longer immune. So aren't you overcounting the immunity? And frankly, I feel like you're being a little optimistic about our ability to come out of COVID as quickly as you say.
No, a good point. So there are two issues there. One, these calculations do assume, unfortunately, a continued number of people getting infected, and therefore, the number of people with natural immunity is going to increase also between now and March. But I did, in the calculations, subtract out the cross product, so to speak. I subtract out the people who will get double immunity from having the virus and being vaccinated.
Okay.
Those people are only being counted once. And in fact, I did allow for the fact that, oddly enough, it's a bizarre reality, but if you look at surveys, the people who are most reluctant to get vaccinated are also the people who are most reluctant to wear masks.
Yeah.
And so it may well be that there is a slight, I'm assuming the probability of somebody getting vaccinated is independent of their the probability of catching the disease, but there may actually be, I may not need to subtract the full cross product. Now, with regard to fading immunity, yes, that is a risk. The studies, though, seem to be reasonably promising there. They say that at least through 6 months now, they're confident that you retain some immunity to COVID-19 from having the disease. So I think some of that is there. And then the other thing that I think is terribly important is, while the rollout of the vaccination is sporadic and chaotic in many ways, there's one thing that we are basically getting right, which is very obvious, which is vaccinate the old people first.
Yeah.
Because if you look at the fatalities last year, it's really astonishing that 81% of people who died last year from COVID-19 were over the age of 65. Now, that group is only 17% of the US population. So long as we can get to them first, we can cut fatalities by 80%. I believe fatalities could well be down by 80% at some stage in April, just because we have succeeded in vaccinating almost everybody over the age of 65. So I do think that fatalities will fall faster, but I do grant the risk that people will catch it a second time. And the vaccines themselves are not 100% effective. So I accept that there might be a little bit of positivity in that. On the other hand, I'll give you a third hand there. I've only assumed the Moderna and Pfizer vaccines. I've not added in the possibility of other vaccines getting used in a widespread way, and I suspect they probably will.
And you mentioned in passing the fact that there are additional variants
Yes.
and the vaccines seem to be less effective at this point, at least against the variant developed in South Africa.
Yeah.
And that could continue to happen too. I obviously hope with all my heart that you are right, but I'm a little more skeptical that by the end of July, we're going to be into post-COVID.
Well, I'm not quite saying that. I think that by the
Okay.
end of July, we will achieve the about 80% of people having some immunity. And I believe that at that point, every adult who wants to have the vaccine will have had it. We still have the issue, which of course is very important to your members, of what are we going to do about vaccinating kids? And you know, that they, you know, right now they obviously the CDC and scientists are working on trying to prove or find and prove that a vaccine is safe and effective for the for children, which is very important to everybody. But I will also say that, you know, my experience of other crises in my lifetime in American history is that when you have a crisis, before it happens, nobody believed it could happen. At the worst of it, everybody is waiting for the second shoe to drop. I mean, I remember years after 9/11 saying it's just a matter of time. I remember years after the great financial crisis, with people saying, "Well, you haven't looked at this problem or that problem, or the bank's going to blow up." And so, I'm watching the news coverage of this. I'm trying to be as unbiased as possible about this, but there's tremendous coverage of these variants. But so far, it seems that the vaccines have at least some efficacy against most of the variants out there, and that particularly with mRNA vaccines, it is possible to tweak them. Now, you're still going to have to go through the approval process, but as the summer is going on, I know they're working on tweaks to try and deal with these variants. So ultimately, I think science will succeed here. It's not going to feel normal for a long time. And I think over the summer, we'll reach a point where we're kind of beating this thing. But, I think, and that means, hopefully we'll be able to get back to normal in the fall. But I'm not really saying we're going to feel like it's normal in the summer. I'm just going to say we're going to begin to act a little bit more like it's normal in the fall.
Okay, thank you. Thank you so much for that.
Sure.
Thank you. I believe Mike Haddad, did you have a question for David?
I did. Thanks, Deborah.
Hi,
Hey, David, great presentation. I am with BAM investment staff. The question I have for you has to do with portfolio construction. And one of the elements of portfolio construction that the TRS portfolio has had for a while and benefited from greatly is exposure to long duration treasuries. We kind of use that as part of our Barclays Ag portfolio, but we've changed the weightings and changed some durations around to have that portfolio, have that element of the portfolio serve as a risk mitigant as well as income generation. We've benefited greatly from the negative correlation of returns between long treasuries and the public equity markets. So I'm wondering, what do you think of that correlation going forward? And if you are of the view that it's going to be less negatively correlated, speaking of returns, is there a different asset or asset class that you would recommend us to consider to serve as a risk mitigant to the risky part of our portfolio, if you will?
Yes, I mean, unfortunately, if you think about long duration bonds as a sort of a recession vaccine for your portfolio, unfortunately, the efficacy of that vaccine is also diminishing over time because, if we do hit another recession, there's a limit to how much of a capital gain you're going to get out of that long duration portfolio. That one of its benefits, of course, is it stops you from investing in things that are more positively correlated to to the market, the stock market. So I am concerned that it is going to be less effective insurance going forward. It may still have some role in protecting against recession, but the problem is that if the next market correction is one in which inflation features as well as a stock market decline, that could be a pretty, that could negate the ability of that long duration portfolio to help you out at all. So if possible, I would try to dial back on that in terms of the risk that you face. But what you need then is uncorrelated assets, which are not particularly sensitive to the business cycle. So they're, to the extent, there are plenty of areas, as I know John O'Shea probably talks to you about, but there are plenty of areas of alternatives where you can get an income stream which seems to be less business cycle sensitive. That's one area. I think also real estate has got some positive correlation with inflation, which kind of helps you in generating income. But the other thing then is just find some synthetic way of buying that that kind of protection, because one of the most expensive ways I think you can buy protection right now is in the long dated treasury market. So if there's some synthetic way of limiting risk, I think that might be a way to go. I also think that over time, as I said, within the equity market, there is equities are changing their characteristics here. There are certainly areas in value equities which I would almost regard as long duration bonds with certainly a better yield than you can get in the fixed income market, and also obviously some potential for upside. But I think you may have to think about the overall riskiness of the portfolio. If your basic insurance policy is more dodgy than it used to be, that unfortunately I think does limit your ability to take risks elsewhere in the portfolio, because you just can't offset that beta risk as easily.
Thank you.
It's great. Are there any other questions for David?
Deb, I have a quick one.
Okay. David Kazansky.
So for seemingly years prior to 2020, we were always talking about how so much of the market was overvalued. And there was somewhat of an expectation among some that maybe the pandemic would be the thing that kind of leveled everything off. And instead, everything seems to be continuing to be overvalued. How does that factor into your look at the markets going forward? Because it seems to me that you're saying things are going to just continue, and earnings are going to continue to go up, and valuation is going to continue to go up. And so do you see a point where we're going to level off and see that correction? And is that coming in 2021 or beyond? And is that at all tied to how successful vaccinations become?
Okay. So the different pieces to this, I think one, I'm a little bit at fault for not re-emphasizing the fact that returns will be more modest going forward. We have, while I think the top 10 stocks in the S&P 500 are much more expensive than the rest of the market, the whole thing is expensive. And so I do think that limits US equity returns over the next 5 years. I would expect to be less than 5% in terms of total return, maybe less than 4% or less than 3%, but certainly less than 5% as an average return. And I expect that based just on where valuations are right now. I do think that will probably encompass a correction at some stage. And I can't time that correction over the course of this year. I don't think that correction is necessarily going to be caused by a delay in the vaccine. I mean, after all, the virus itself didn't knock the market for a loop. I think the real issue is, I think inflation is the greatest vulnerability that this market has. If inflation picks up and interest rates get forced up, then those valuations look particularly dangerous for long duration bonds and for growth stocks and for some of the more speculative areas of markets. And that I think that's where I think the biggest risk is. So I am nervous about it, but the other thing that I think needs to be said, and this is a very basic point. I mean, we've actually, in a way, been heading on a disequilibrium path for the last 40 years. If you look in the 50s, 60s, 70s, 80s, the total value of US financial assets was about 2.5 times the total value of US GDP. And since the mid-1980s, that has taken off and it's now about 5.8 times. Bonds have gone up, stocks have gone up, various other financial assets have gone up. The Federal Reserve has printed lots of money. So you've got all these assets, but relative to GDP, financial markets are going up much more. Now, first of all, how have they done that? And second of all, what's the consequence? I think the reason that's happened is because there's been, at the same time, a significant increase in inequality, a massive increase in inequality, really in the same direction. And what happens is, the top 10% of households back in the 70s got about 35% of the income, actually less than that. Now it's over 50%. The reason that's so important in this is the big difference between the top 10% of households and everybody else is the top 10% of households save about 30% of their income. Everybody else basically spends all their income if you aggregate over the other 90%. So as more and more income has been received by the top 10%, you end up with more saving and less spending. There's a circular flow of income. You produce $100 worth of income, that's of output, and that generates $100 worth of income, and that income is supposed to come around and buy the output. What's happening is every year, half that income is going to people who are saving 30% of it. And what that's doing is it's leaving us short of demand, and so we're always trying to stimulate demand in the economy. But it's also funneling money into financial markets, boosting asset prices across the board. Now, how does that come to an end? I think the way it comes to an end is if you have policies which are designed to try to redistribute income or wealth away from the top 10% of households towards the rest of the population. The rest of the population are more likely to spend that money, cause excess demand, cause inflation, and that in itself could bring down the asset prices. So that could cause a compression of asset prices relative to GDP. So it's not the vaccine. What I'm interested in is at what point will we reach a tipping point in terms of inequality in public policy by which government policy is aggressively designed to reduce the gap between the rich and the poor, as opposed to sort of standing on the sidelines. And if that happens, I think that's the thing that could cause a significant correction.
Great. Thank you. Good answer.
Sure.
Great. Any other questions for David? No. Okay, so we thank you very much. This was very interesting. We appreciate your time and the presentation.
You're very welcome. Thank you.
Thanks, everybody.
You're welcome.
Stay
Be well.
You too. Bye now.
Thank you.
Okay. All right, we've come to the end of our public session. Are there any other questions or comments from anyone before we go into executive session? Hearing none, do I have a motion to go into executive session?
So moved.
Thank you, Mr. Brown. Do I hear a second?
Second.
Thank you, Ms. Dickers. All those in favor, please say aye.
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 Okay, any nays? Okay, we're going into executive session. Okay, welcome back to public session. Ms. Stang, would you like to report out?
Certainly. In executive session, we had a discussion on a policy within the emerging markets asset class. We reviewed our securities lending program within the variable funds. We discussed the progress made on the investment policy statement for the variable funds. We discussed a contract issue. Consensus was reached, which will be announced at the appropriate time.
Thank you so much. Does anyone have anything else for public agenda? Public meeting? Okay, then do I hear a motion to adjourn?
So moved.
Thank you, Mr. Brown. Here a second. Thank you, Mr. Kazansky. All those in favor of adjourning, please say aye.
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 Great. Any opposed? Discussion? We stand adjourned. Stay well, everyone.
Take care, everybody.
Aye.
You too. Thank you.
Take
Bye.
care.
Thank you.
Bye.
Bye-bye.